What's up, everyone? It's Scotty with Money Vesting. So, a very, very important and interesting report released by Wolf Street and Wolf Research. So, I definitely wanted to go over that, which basically goes over the treasury holdings by foreign investors in foreign countries and how there's been some very, very important changes in the basically treasuries held at foreign countries. And of course, how that's going to impact the treasury yields, the bond market, the treasury department, the fiscal policy side of things. So all of that is going to be covered in this video. Hope you guys are doing great. I am finally back home in India. It's been one crazy journey of over 41 hours with a couple flight delays, 2 lost bags, 3 rebookings, 2 missed connections, 9-hour layovers. It's been just a mess. And but yes, I'm safely back home in India. I'm still waiting on my bags though. They're still in London. So again, thank you so much for joining. I really appreciate it. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. We are back at it. Going to start doubling down on content once again. Live streams, trade idea videos, stock analysis, macro updates, fundamental, technical analysis. Everything is going to be covered. And of course, we'll be doing videos on that here moving forward. Again, make sure that you drop a like, subscribe, and link to our Discord. Patreon is going to be down below. There is a 16% annual discount that we have restarted till the end of this month. So if you want to take advantage of that, link's going to be down below. So this right here was the research. So time to look at foreign demand for incredibly ballooning U.S. national debt. Who is buying the ballooning U.S. government debt that has now reached $33.5 trillion? That's on everyone's minds for now. There is way too much demand for long-term treasury securities, or else the 10-year yield wouldn't be at 3.8%, but 6.8%. So what the writer or what the author really they're saying there is right. I mean, if there's a lot of demand for any asset, the price is going to go higher. And the yield, which is the coupon payments from the treasuries, will go down. Well, actually, the coupon will stay fixed, but as the price goes up, the yield, which is coupon divided by the price, starts to go down, right? That's the yield going down against the price, which is going higher. That's the inverse correlation between the two. And the 3.8%, 4% dividend treasury yield basically suggests that the demand for treasuries is still very, very strong. Otherwise, if it weren't the case, it would have been much higher to attract more buyers. So the 30-year yield would be further north, but maybe someday yields will have to rise to lure more buyers, and yield solves all demand issues. If you can sell them at 5.5%, try 5.1%. Just about anything will sell if the yields are high enough. That's why even junk bonds find eager buyers, but we're not there yet with treasuries. So in total, all foreign holders held about $7.3 trillion in treasuries in May. That's down a hair from the record holdings in April, but up about 2.4% from a year-over-year basis, according to the Treasury Department's TIC data. By contrast, the holdings of China and Hong Kong combined, purple, fell by 6.6% from a year ago, and the holdings of Japan, which is in green, also fell by 10%. So two of the biggest sort of holders of U.S. government debt, they did drop on a year-over-year basis. So all countries combined, which is the red line, went up from like $5 trillion to over $7.5 trillion. So that's very strong. That's coming in since, I believe, from a few years ago, several years ago. I don't remember what the dates were on this chart. Let me just go over it. From 2014. But if you take a look at purple and green, which is more specifically China and Japan, they were down, again, 6.6%. and 10.1% respectively. Purple, by the way, is going to be China and Hong Kong together. So this right here is going to be foreign holders became less crucial. So this is the percentage of U.S. Treasury securities held by foreign holders. Now, this is a little bit more of an alarming chart because 34% of U.S. Treasuries were held by foreign holders compared to now, which is at just under 25%. So the reliance for the U.S. on foreign investors, it has certainly come down quite a bit. But that's also because, again, the China, Hong Kong, they're kind of pulling back, they're kind of unloading some of that debt, and the U.S. in itself within is also buying, as the Federal Reserve was one of the biggest buyers of U.S. Treasuries, mortgage-backed securities, and their balance sheet also ballooned, right? So on one hand, you've got foreign holders, which is China, Japan, Hong Kong, some of the biggest ones, unloading, and on the other hand, the Federal Reserve was buying over the last couple of years as part of their quantitative easing in order to basically fight COVID, which obviously was prolonged for such a long time. Now inflation's a problem, or has been a problem for several months. But you can see again, the total federal debt has declined from 33% to 24%. That's the foreign holdings as a percentage of total federal debt. In other words, the U.S. debt financing has become less dependent on foreign holders, partly because of the Federal Reserve and what we discussed, their balance sheet's gone up. So if this chart's gone down, the other chart, which is the balance sheet of the Fed, has basically gone up. Now, Moving forward, you'll notice that US securities held by Japan, it's been zigzagging quite a bit. So again, since 2011, they've been around $1.4 trillion level. They started at around 1 trillion. They kind of pushed up to 1.3, but then more recently, again, they've unloaded it all the way back down to under $1.1 trillion. This right here, US securities held by China versus China plus Hong Kong. So again, you can see since 2011, that number has been consistently coming down from 1.3, 1.4 trillion all the way down to under $900 billion now. And this also does explain why Janet Yellen did spend as much time as she did in China, because again, they're looking to raise more capital, do a lot more auctions, 850 billion in June. This was again one of the largest auctions by the US Treasury Department as part of their fiscal policy ever, in order to make sure that they have the funds to run the country. So this is again quite an interesting piece of information. And this right here, the UK, which is the third largest foreign holder, they have been the ones that are buying, and you can see that they have now reached over $667 billion in May, up 4.7% from a year ago. City of London's Global Financial Center. So this isn't the UK government or the Bank of England propping the US market treasuries, but it reflects activities of the financial centers. Holdings have reached a new record in March. So this is not the City of London, Bank of England, or the UK government, but instead it's just really the financial center, the banks, the private equity, private firms that are really just propping up and of course buying US government debt as part of their portfolio strategies. This right here, even Canada, $266 billion to a record, up 17, almost 18% year over year. India reaching over $240 billion. So what China and Japan are kind of unloading, it's all being bought by India, Canada, the UK. And even Taiwan, you'll notice it's at over 250 billion. It's been going up since 2018, quite substantially. So that's where we are. And again, the demand continues to be there, but at some point, it's going to get to a level where we have to kind of reassess and evaluate what's going to be the end game here, because of course, we know that, this is not a sustainable path to be on, where the US government keeps on spending money and the tax revenue is nowhere near close to make up for the deficits that we run every single year. And to finance those deficits, of course, the US government basically issues a lot of bonds, and all these countries are still, well, at least for the most part, are willing to buy, as 4 to 5% on US dollar denominated bonds is very good compared to, again, their own currencies, especially when you compare to India, Brazil, even the pound, and even some other currencies over in Europe, Taiwan, other places where you're also getting the capital appreciation, but you're also getting the full credit, backed by the US government, and of course those coupon payments. So, but at some point, again, this is going to be more of a risk factor, more of a long-term thing that we have to kind of assess and understand for ourselves, because eventually, again, rates could go higher as there is more perceived risk considering the level of debt. And of course, the interest payment on that debt alone is going to be more than $1 trillion here very soon. So let me know in the comment section below, what do you think? Again, hope you guys enjoyed this video and a quick update. It was a very, very interesting update. Again, China, Japan, and Hong Kong kind of unloading a little bit, and a lot of the other buyers stepping in, such as the UK, India, Taiwan, and Canada as well. So hope you guys saw this video, found it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord, Patreon is going to be down below. Would love to have you on board. As always, happy investing. I'll see you all in the next video.